The Money Show.
Investment School.
Before we get into tonight's investment school, I think it's important just to understand a phenomenon. I've seen a logo on tonight's guest's chest. He's on a video call to us from London. His name is Deon Gouws. He's the Chief Investment Officer at Credo Group. It's not a fashion brand with which I'm familiar, Deon. It looks... I've heard of a tank top, but never a cannon top. What is that little logo where the crocodile should be or the pony should be? What's that logo on your chest?
Bruce, I'm hoping that some viewers will recognize the fact that this is an Arsenal top. And I wouldn't normally disclose my tribal identity on a show like this. But I had no choice because you invited me for a live interview 1 hour and about 18 minutes and 45 seconds before kickoff at the Emirates Stadium. So my teenage daughter and I, in about 20 minutes' time, will be running for the tube to try and be at our seats at 8 o'clock tonight local time for the match against Chelsea. So yes, I'm a long-suffering Arsenal fan together with a few other people in the South African investment landscape.
What is it about people like yourself and David Shapiro, long-suffering Gunners fans? Is it that if you're a Gunners fan, you've got something that's going to be more disappointing in your life than investment markets? Is that why you keep supporting them?
I think that's a good summary. In fact, if you look at my Twitter bio, Bruce, I disclosed there that I like running marathons and I like the music of Leonard Cohen. And of course, I'm an Arsenal supporter, and I do all of those things just to show to people that investing is not the only painful activity that I enjoy.
Let's talk about investing and money. I mean, interest rates, we got America going to make an interest rate decision tomorrow. Inevitably, rates will rise. Inflation is as sticky as hell. Banks are under pressure. We saw JP Morgan over the long weekend buy into First Republic Bank and avert another crisis. The world is feeling very, very antsy, tentative, and directionless at the moment.
Bruce, yes, but to be honest, I always say to people who stand on a stage and who make the statement that markets are more difficult or more uncertain than ever, I always say, show me a time in the past where, if you went back to that exact time when markets actually felt easy. Markets only feel easy in hindsight. We look back and we look at bull market cycles and we can explain why the market went up. But that's something which is called the narrative fallacy. It's a theory we arrive at after the fact, as if we always understood it as it was happening. And in fact, even better, as if we might have forecasted if you go right back to the beginning. So where we are today, for me, is not very different to every other period of uncertainty in the market. And that's practically all the time in the markets, as I'm trying to say. And then, in terms of, looking ahead, I personally, take note of all those points that you make, all those issues, all those realities, all those risks, and they're all valid. And they're all potentially, disconcerting. But to cut a long story short, I don't think that should put people off from investing, from putting money at risk in the equity market to the extent that they can afford equity risk. And ultimately, I say so because of, what the long term has proven. Equities have rewarded risk takers for as long as, we've had records. Credit Suisse publishes an update to their century study, which takes market data back to 1900. And it shows us that if you were exposed to US equities over a period of 120 plus years, you would have made a real return after inflation north of 6.5% over that full period. For international equities, the number is slightly lower, but it's still over 5%. So the market rewards you for the risk you take. There's no such thing as a free lunch. The market presents you with risks, but at the same time, in that lies the opportunity.
But it is that thing of almost blinding yourself to the short-term noise and droning out the clutter and just going, I'm going to be putting in money every single month into a portfolio of shares, whether it be the S&P 500, whether it be the FTSE 100, whether it be the Euro Stocks 100, whether it be the global index, the MSCI, any one of the multiple MSCI indices that reflect the world. Ultimately, I will be rewarded disproportionately to people who panic in and out of positions consistently or don't invest at all, which is worse.
You're dead right, and specifically against a backdrop of committing to that strategy for the long term. Because in the long term, you will get volatility, you will get drawdowns, you will get greed and fear and market cycles. But if you've got a long-term view, and if you're a younger listener or viewer tonight, and by that I mean anybody who's, maybe in their 30s and 40s, people with a investment horizon of 10, 20 years plus, you should actually embrace the times that the market does go down, because it means that those regular monthly contributions that you refer to, Bruce, are being reinvested or being invested, being deployed to the market at more attractive levels. So for the same monthly commitment, you're getting more shares of all these, world-leading companies. So in the short term, a market drawdown is an opportunity for an investor who's prepared to look beyond the noise. Obviously, if you've got all your money in the markets and you need to start using it because you're in your 60s or 70s, but then drawdowns are a little bit more risky and a little bit more worrying, but perhaps you shouldn't be all in equities at that point. And that's a conversation, for another time.
Yeah, but I mean, how do you invest your own money? I mean, do you walk the talk? Because what you're doing is classic investment speak. Invest for the long term. Long-term markets will reward you. Do you live by what you preach?
I absolutely do, Bruce. I think if you had insight into the Modest Host family portfolio, you will see that I'm 98% in equities as we speak. And the only reason it's 98% and not 100% is, to the extent that I've got a little bit of spare cash from the last, few months, perhaps. I don't always, deploy it at the first possible opportunity. But the one thing I don't do is to look at my portfolio and to look at the noise in the world and all the risks, the kind of things that you mentioned earlier, and to say, based on that, I'm going to sell 10, 20, 30%. And in fact, I think maybe the most practical example of this would be March 2020, which we will all remember well. A little over 3 years ago, we had this COVID thing arriving from nowhere. The world went into lockdown. There was no precedent for this. The CFA handbook didn't tell you how to invest when the world goes into lockdown and economies basically closed down and the market drops by 35% in 4 weeks in that period. And the number of conversations we had with clients, and of course, I'm not claiming that at the time. This would be a classic narrative fallacy if I was going to say to you that I knew exactly what was going to happen next. I had no clue. I'm also human. I was also fearful and uncertain and looking at this and wondering what next. But the one thing I didn't do, and the one thing that we didn't do as a firm, is we didn't sell out of equities. So we could tell with conviction to clients who was asking us what to do. We could say to them, listen, we don't know what's happening next. We have to be honest. We've got no clue really. But the one thing I'm not doing is I'm not selling. Because I know that if I had spare cash, this is a buying opportunity, not a selling opportunity, based on all the history we've got. So at least we had that conversation. And by sharing that not even an insight, but by sharing that truth more than an insight, and by clients knowing that you meant what you said, we managed to essentially talk most of our clients off the ledge, and practically nobody sold. I had one conversation with a client who sold some money. In fact, he was quite clever. He did it even before the drawdown. He did it in February. The problem with him was that he never put his money back, when the opportunity presented it later on. I actually wrote a column about that little incident, Financial Mail a couple of years ago, without, of course, disclosing the identity of the client.
But a lot of people say, you know what you need to do? You need to find people who create value. You need to back the Elon Musks of the world, the Steve Jobs of the world, the Zuckerbergs of the world, the Bill Gateses of the world. You need to make them work for you. And it's a lovely hypothesis. It really is. Until you say, you know what, we need to look at the local market. Yes, you know who was clever? Christo Wiese. Let's back Christo Wiese. And I've just finished Whitey Bosson's biography because I'm talking to him at the Franschhoek Literary Festival in a couple of weeks' time. And the book reminds us of how Whitey Bosson resisted Christo Wiese putting ShopRite into the Steinhoff calamity. He put Pepcor in, he put a whole bunch of assets into it, and it wiped out a large proportion of his own wealth. And investors who'd followed the philosophy of letting Christo Wiese work for you, you would have got stung too. None of these guys is perfect, but there's a I think a warmth to getting them to work for us.
I think absolutely, and I think the example you mentioned, clearly it's valid. Of course, if you backed Christo Wiese earlier in his career and went for the ride, you could have made good money out of him. I remember when I started my career at Old Mutual back in the 1990s, call it 25, 26 years ago. Christo Wiese, of course, was already on the landscape and doing well, but there were other people like Bill Joffe. Practically everything that he touched turned to gold, and you just know if you back people like that.
Bill Lynch and Brian Joffe, to Bill Joffe was like the combination of the two.
Exactly. You're dead right, both of them, Imperial and Bidvest. And in fact, they're both valid examples, going back to those days before Bill Lynch sadly, died quite prematurely. But you're dead right. There were two examples going back 25 years that you should have just followed. in order to avoid the risk that perhaps Visa may have exposed you to if you followed his money, with a Steinhoff deal. I mean, that just goes back to another point of the whole investment conversation, which is never put all your eggs in one basket. Yeah. Always diversify. It's the only free lunch in investing. And yes, you can certainly make mistakes. I know a lot of people, some very close to me, who lost a significant amount of money in Steinhoff. Of course, there's a whole debate just around that specific example. But diversification would have been your friend in that regard if you invested in that manner.
We're talking to the Chief Investment Officer at Credo Group, Deon Gouws, about investing and how, I suppose next we'll talk about how his investment approach has changed over time. Do you stick to one particular formula or do you flex and change as time passes? That with Deon in a moment.
The Money Show. Investment School.
Chief Investment Officer at the Credo Group in London, Deon Gouws, with us this evening. How do you flex your investment approach, if at all, Deon?
I think I'd answer it like this, Bruce, to say that I don't really flex it very much anymore. And what I mean by that is I don't try and adapt my investment approach, based on market circumstances or an inflation forecast or any of those factors that you mentioned at the beginning. Because as my response at the time suggested, I think most of it is noise, and I will remain committed to an equity portfolio in my own case. By the way, I don't recommend 98% equity exposure to all listeners, because it might not be right for your risk profile. It might not be appropriate. You might not be able to afford all that risk. You might not be able to stomach that risk based on your personality and your own emotional circumstances. So I don't really try and time the market, or to use the technical term, to do tactical asset allocation. Something that I don't really do and we don't really do as a firm. However, I think if I look back on my career, I've been investing in the market since the 1980s when I was a student, and professionally since 1996. And my investment approach has changed. There's the classic saying, which is attributed to Napoleon, although when you do research on the quote, you'll see that it was only in print about 100 years after Napoleon died. There's still a beautiful quote where it says that to understand a man, you need to know what happened in the world when he was 20. I was 20 in 1984, and South Africa was quite a rough place. I know some people, are in despair about South Africa today, but in 1984, there were police killing people in the townships, and there were bombs going off at a spot. We were really the backwater of the world just before the Rubicon speech. And the point was, it was a risky place. And I think it meant that in order to survive, you needed to embrace risk. Roll on to the 90s, and eventually, as I say, I started my investment career. The opportunity was great. The new South Africa freedom arrives. The tech bubble was building in Silicon Valley. And my own risk appetite, went up even more. And in the process, I learned some important lessons. I wrote off money. I think it's great to learn important investment lessons, and for these lessons to cost you money when you don't have a lot of money. So rather learn it early in your career, early in your life, when you can write off a relatively small absolute amount, which I certainly did. And I think what that meant ultimately is that my own risk profile and my approach to the kind of equities that I bought and my approach to my own portfolio is less risky today. It's much more focusing on the fundamentals, on the quality, on the value, and holding on for the long term, and very much ignoring the noise. So to cut a long story short, I think my risk profile has gone down. I think I've certainly slept better as a result. The one thing I'm thankful to say is, even when I was taking more risk for myself, I think I've always been a better investor for clients and a more responsible investor for clients than I've been for myself. So even though I wrote off, some of my own wealth early on, hopefully the client experience for those people who may be watching today, who've known me for that long, has not been an equally exciting ride.
You get people who go, oh, we only invest in growth stocks. Oh, we only invest in value stocks. And I kind of look at this binary approach and I feel sorry for them. And I think you do too.
Well, I think ultimately there's a place for both. For a piece of my career, I was a multi-manager, and I saw some of the world's best value managers and some of the world's best growth managers, and I saw them all around the world. Most of them in the US, because that's where most managers are, in places like Boston and the West Coast. And I learned that you can be a successful growth investor and you can be a successful value investor as long as you've got a clearly defined philosophy, a consistent process, and you stick to it over the long term. And it helps to have consistency in a team as well. So all of them can work. Ultimately, I think if you look at the long-term history of investment returns, I think it is true that on balance, value works better than growth, especially at a simplistic sort of one-dimensional level. We've got 200 years of returns to prove this. And I say this in spite of the fact that often in the short term, and the short term can be as long as a decade or more, often in the short term, growth will outperform value. And we just saw it ever since the financial crisis, essentially, for for 90% of the time in the last 12, 13, 14 years, growth has been in favor. Calendar year 2022, value was very much in favor. And we as a house at Credo, we are value investors, so we benefited from that. So ultimately, we are value investors because, as I say, over the long term, it works. But within value, I think you've got to be careful. You don't want to be a deep value investor. You don't want to buy value just for the sake of value, because often the cheapest shares in the world are cheap for a reason. Essentially, they're broken business models, and they're likely to get even cheaper, so-called value trap. So you don't really want to be a deep value investor. So we invested at what we call the intersection of quality and value. I think the best quote about this is a Charlie Munger one, Warren Buffett's sort of mentor and partner, where he says it's much better to buy a wonderful business at a fair price than a fair business at a wonderful price.
At that point, we will leave it because you have a train to catch. Literally, Deon Gouws, Chief Investment Officer at Credo in London.